Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, U.S. stock futures rebounding this morning as traders ramp up interest rate bets following comments from Fed Chair Powell. Also helping drive risk appetite, a strong start to the corporate earnings season. But trade tensions still linger in the background. Gold pushing higher to a new record of $4,200 an ounce as traders monitor the developing situation between the U.S. and China. Plus, bank earnings continue to roll out. This morning, we heard from Bank of America and Morgan Stanley. Morgan Stanley posting a 35% increase in trading revenue, a 44% boost in investment banking fees. Meanwhile, over at Bank of America, it's of course the second largest U.S. bank. It beat estimates on net interest income and saw a strong quarter for investment banking. And ASML as well out with its earnings. The Dutch chip equipment maker saw strong demand from artificial intelligence. The boom in AI infrastructure spending helped it bring in $6.3 billion in bookings for the quarter. However, China risks do still loom over the company. It faces restrictions on what it can sell to China, stemming from U.S. attempts to slow that nation's chip industry. Let's get a check in on stock futures right now. We are seeing indications for a higher open, a bounce back from some of the volatility that we've seen lately. At least that's how it's looking for now. And we have all three major averages pointing to gains at the open. In the case of the Dow, about 0.5%, the S&P 500 stepping up to 0.75%, and the NASDAQ leading gains, perhaps spurred in part by those ASML numbers showing a gain of about 1% at the open. Let's dig into our top stories of the day. Big banks reporting more strong earnings as deal making boosts profit. Gold hitting a new record high above $4,200. Plus, President Trump threatening to end cooking oil purchases from China as the trade war escalates. Joining me now is senior reporter Brooke DiPalma live at the NASDAQ, senior markets reporter Ines Ferre, and Morning Brief Market Sunrise host Ramzan Karmali live from our London studios. Brooke, just like we did yesterday, going to start today with bank earnings, and the themes feeling pretty similar here.
Yeah, pretty similar indeed. Deal making, that rise that we saw in the equity markets to record highs, and all those mergers and IPOs that we saw in the third quarter really contributed to both Bank of America and Morgan Stanley's strong earnings report that beats Wall Street's expectations. And that's why you see both stocks moving higher in this pre-market hours just this morning. Taking a deeper look into Bank of America specifically, what we saw there was their investment banking or those deal making fees. We saw those increase by about 43% from a year ago to $2 billion. Now, keep in mind, during this past quarter, Bank of America played a large role in that Union Pacific agreement to purchase North Forest Suffolk. So that really contributed to that portion of the business as well. In addition to that, we did have client trading rise about 8% to $5.3 billion, really showing this willingness of investors to get in on this market and the activity that Bank of America saw. And it was a similar story over at Morgan Stanley. Taking a closer look at those numbers as well. Investment banking fees, once again, those deal making fees, those were up about 45% to $2.1 billion. Now, they also advised on that deal that we've been covering quite closely of Keurig Dr. Pepper to acquire JD Peet's, a Dutch company as well, the Dutch coffee company. Also, in addition to that, we did see trading revenue from Morgan Stanley that was up about 24.5% to $6.2 billion. And that's combined equity, fixed income, also currencies, as well as commodity trading. But specifically within the equity trading revenue, that increased 35%. And so really, both of these earnings reports really fueled by this record high rally that we've seen, and also this deal making environment that has largely returned after a bit of a slowdown earlier this year.
And in addition to bank earnings, of course, we've got other earnings coming out. I mentioned ASML. Ramzan, what do we hear from the Dutch chip equipment maker? And what does it tell us about sort of where we are in the AI trade right now?
I'm definitely going to avoid saying that phrase. So ASML is really benefiting from the AI boom. Its share price, not only on the NASDAQ in the pre-market, up over 4%, even in its home country, the Netherlands, also up over 4% there too. Now, remember, it recently became the most valuable listed firm in Europe, and it's among the companies in the semiconductor industry which have been impacted by tightening US chip export restrictions to China and US President Donald Trump's threat of tariffs on the sector since he took office back in January. Now, the stock, as I said, is being propped up by their they're pretty impressive earnings, to be honest with you. In short, it beat estimates with bookings of 5.4 billion euros. That's around $6.3 billion. And even though orders from China are down, and actually that might not be a bad thing for investors, given that Europe as well is trying to up its efforts to decouple from Chinese tech in the name of national security. So perhaps not such a bad thing. Now, the chip giant also, though, did say it does not expect 2026 total net sales to be below 2025 and will communicate further on its goal in January. So we'll really have to wait to see what they say in January. But overall, a pretty rosy picture from Europe's largest company.
And by the way, it had overtaken LVMH, which was the largest company there for a little while, which also reported earnings. That's a sidebar. Ramzan, you mentioned China and what's going on with ASML there, but let's zoom out and also talk about the latest between the U.S. and China, because there continue to be new wrinkles in that relationship.
Yeah, these tensions continue to simmer. That's not a pun. President Trump has threatened China with a cooking oil embargo, and that's in retaliation for Beijing's refusal to buy US soybeans. He posted on Truth Social, where else? I believe that China purposefully not buying our soybeans and causing difficulty for our soybean farmers is an economically hostile act. We are considering terminating business with China having to do with cooking oil and other elements of trade as retribution. So it's pretty firm words there on Truth Social. Now, China has been the top buyer of US soybeans by far, but it's not bought not one single American soybean in recent months amid this ongoing trade spat. Last year, get this, it bought $12.8 billion worth from the US. So it's quite a big chunk here. But on the flip side, the US was China's top market for used cooking oil. So basically, China imported at roughly $1.1 billion worth last year. But after China cut tax rebates late last year and the US imposed tariffs on Chinese goods this year, imports, well, they've absolutely plummeted. They've fallen by 65% between the period of January and August, and are roughly standing at around $285 million. So a massive drop off there as well. Now, the president's latest criticism follows a recent list of sort of pretty critical remarks he's made about China, which kind of raises questions about the status of these ongoing trade talks between the number one and number two economies in the world. And also maybe it casts further doubt about whether President Trump will meet his Chinese counterpart Xi Jinping in South Korea later this month, which is what everyone was hoping they would meet, and maybe we could get some sort of breakthrough in these trade negotiations.
Yeah, so by the way, that was absolutely a pun, Ramzan. So we're going to keep monitoring all of that. But in addition to that, all of those cross currents making their way through the equity market, of course, they're also making their way through the metals market. Ines, I know that you've been watching the gold trade very carefully.
Yeah, and gold futures are up about 60% year to date now. They have been making high after high, and Ed Yardani just put out a new note about gold being the new Bitcoin, basically talking about how the prices of gold has obviously surpassed 4,000, which is what a lot of Wall Street had been anticipating for 2026, 4,000, and right now we're touching around 4,200. But basically what he's saying is that investors are preferring gold over Bitcoin, and he's saying that Bitcoin is more of a risk on, gold is more seen as a risk off safe haven during geopolitical turmoil, so to speak. And Yardeni is saying that gold is the physical Bitcoin. So just as Bitcoin is seen as digital gold, well, he's saying that gold is now the physical Bitcoin, and the target for 2026, his firm has the target at 5,000. That coincides also with B of A, which earlier this week also bumped its price target for gold for 5,000 by the end of 2026. Also saying that gold could reach 10,000 by the end of the decade. I mean, you've had so many sort of contributing factors towards this rally, starting with central bank buying, with Fed easing, with the dollar easing as well. All of this has contributed to this massive rally that we've seen in gold.
And of course, it's not just gold. As you know, silver has been joining the party too, Ines.
Yeah, so silver tends to move alongside with gold. It tends to do a hockey stick move, and it has certainly done that because you've seen that silver is now up 75% year to date versus almost a 60% for gold. One of the main drivers for silver has been speculative and also inflows into ETFs. And the silver market is much smaller than the gold market. It's 9 times smaller. So when you have that amount of inflows, then you are going to see an outsized move in the silver market. Also, Goldman Sachs recently pointing out the supply crunch that has happened in London because you had this tariff uncertainty this year. So you had a lot of silver that was being transported into towards New York, sent from London to New York. And you saw this across really the metals market in general. And that supply crunch should sort of ease, but that has certainly also lifted up the price of silver or helped lift the price of silver as well. You've had some speculative plays in it as well. So that's why Goldman is saying that near term, you could see silver very volatile, but in the medium term, they're expecting silver to go up alongside with gold.
Well, we'll keep on watching all of it, but 4,200, not necessarily something that a lot of people predicted, say, last year at this time. Thanks so much, guys. Coming up, a morning brief. We bring you today's top trending tickers as we count you down to the opening bell. We'll be right back. Now time for some of today's trending tickers. We are watching Stellantis, Dollar Tree, and Papa John's. First up, Stellantis, announcing a $13 billion investment in the U.S. It's the parent company of Chrysler and Jeep, and it'll make the investment over the next 4 years. The initiative will add more than 5,000 jobs to its domestic workforce and increase domestic production by 50%. The plans include bringing new vehicles to plants in Michigan, Illinois, Indiana, and Ohio through 2029. The announcement comes amid President Donald Trump's efforts to create more manufacturing jobs in the U.S. through the use of tariffs. Next up, Dollar Tree shares jumping after the retailer projected earnings per share to gain at a compound rate of as much as 15% over the next 3 years. The company is also sticking to its previous guidance for the quarter and full year. These projections coming ahead of an investor presentation that's scheduled for later. The company is trying to sharpen its focus under CEO Mike Creedon after selling the struggling Family Dollar chain for about $1 billion. That was far less than the almost $9 billion it paid for the business 10 years ago. And finally, we got Papa John's. Those shares are rallying after Reuters reported that Apollo Global made a bid for the company. The alternative asset manager is said to have made a bid for $64 per share to take the company private. As you can see, it's trading about $10 below that, even with a 10% gain today. The bid could value the company at around $2 billion. It also marks a major move by Apollo to expand its footprint in the quick service restaurant space. And a disclosure, by the way, Apollo, the parent company of Yahoo Finance. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Third quarter earnings season getting underway with big banks among the first to report. Bank of America and Morgan Stanley both rising after strong investment banking revenue. Joining us now, Jeff Krumpelman, Mariner Wealth Advisors Chief Investment Strategist and Head of Equities. Jeff, it's good to see you. Obviously, it's early in the earnings season yet, but what are these big banks in particular telling us about how earnings season could look overall?
Well, we've gotten off to a good start, right? And I think it tells us that kind of, at least to this point, the economic expansion story is still in play. And we certainly like the results that we saw with regard to investment banking, trading, and just really just in their basic core business in the lending area. Credit seems to be, it's not perfect, but pretty darn solid. And so I think, we're still in 3 yards in a cloud of dust on the economy, and that tends to support stock prices. So I think we're off to a really good start.
And Jeff, you recently wrote about valuations, and you kind of said we can't apply the old paradigm to valuations. What do you mean by that, and how should we be thinking about them?
Yeah, I think it's just reflexive to go to historical averages and say, oh, we're at 23 times earnings at the index level, and the historical average is more like 16 or 17. We're in a bubble. And it always gives us comfort. I'm not the first to say this, but if there's a bubble, it's in the references to a bubble. And seldom do you have a bubble when everyone's talking about it. But this is not your grandfather's S&P 500 index. This is a index that is much more comprised the constituents in information technology, communication services, and asset-light growth businesses with superior margins and return on equity or profitability. And if you would compare those statistics for return on equity and margins, it's far higher than we were 20, 30, 40 years ago. And it supports higher PEs. But if that still makes you nervous, I'll tell you, as an active stock, someone who's got to select and pick stocks and manage individual portfolios, the equal weighted S&P 500 is trading at more like 17 or 18 times earnings, not far from the historical average. And we find a number of very attractive stocks with great catalysts and growth rates that are priced well below the average PE and the overall index. So, we embrace active management.
And so, and what kind of, but that implies if you're looking, overall the valuations are higher, but it still sounds like you're looking for stocks with lower valuations.
Yeah, so as part of my role, I'm chief investment strategist, but I also commandeer a group of 12 people. We manage about $15 billion in the equity individual stocks within our equity strategies. 500 billion overall at the firm, but we have a significant amount of assets within individual stock management as well. So yeah, in my group, whether you're talking about information and technology and communication services, where everyone's gaga, we also find opportunities in industrials, financials, and consumer, quite frankly. And I could talk ad nauseum about what we're doing there.
Well, tell us a little bit about what you're doing there and what's standing out to you right now amidst this environment where you have all of this debate about the AI bubble, you have a government that's shut down, you have a president who keeps tweeting or truthing or whatever you want to call it about China. So where do you think the biggest opportunity amidst that backdrop is right now?
Sure. And I'll tell you what I think they are. Just as a preface comment, I would say when we worry is when there's no wall worry. And you just outlined 5 risk factors, government shutdown, trade, speculation about Fed, all kinds of stuff going on. And that actually keeps people sober. And for us, that means there's opportunity. Not everybody's in. So when we look bottom up, forget the macro, when we look bottom up, and where do we find opportunities? Well, first, within AI, we've had a message, don't just go to the stalwarts, have exposure there on the Mag 7. But we find, stocks like GE, Vernova, Quanta Services, that supply power and electricity, power turbines, $500 million power turbines that feed the electricity, thirst for electricity within that construct. And I could go on and on about non-Mag 7 names, whether in cybersecurity or networking, that feed that beast of AI. But outside of that, we have a balance or a blend. Within consumer, we find, you just mentioned Dollar Tree. We own Dollar General. The consumer trade down kind of thesis is very much in vogue. Kroger, AutoZone. These are all stocks that are kind of counter-cyclical and balance out your risk. Uber, DoorDash. I mean, just the idea of eating at home. Strong growth in those areas. So we find consumer attractive, and then I'd round it out by these financials. We do like the brokerage companies, and the money center banks is where we've been, but there could be some real opportunities in regional banks if they've not been part of the party here. The brokers and money centers are up 25 to 40%. The regionals are flat.
Yeah.
So there could be some opportunity there.
And it sounds like from reading between the lines what you're saying that you also think the economic backdrop is pretty good right now. If these are the kinds of, yes, as you said, you're looking at some that aren't necessarily cyclical, but a lot of what you're talking about also relies on economic growth.
Yeah, I mean, our actually forecasts, our chief economist forecasts, and I agree with Bill on that, is not too unlike the Fed, which it's 3 yards in a cloud of dust, 1.5%, 2% GDP growth with contained inflation, if you will. It's a little elevated, but it's very reasonable. And solid GDP growth and very strong earnings. That's a very solid environment. And our thesis has been, as you know, clear air turbulence this year. The reason that the market has gone up isn't PE expansion per se. We've had strong earnings growth. And we expect air pockets from these wall of worry issues where the plane's going to drop in altitude, but it's going to resume back to blue sky altitude because the fundamentals, despite all the fear and worries about bubbles, the fundamentals are quite solid.
Jeff, good to see you. Thanks for joining us.
Thanks for having me.
That does it for Morning Brief. We got much more ahead on Yahoo Finance. Opening bid is next.